Thank you, Professor Sundar, for joining me. It's absolutely amazing to be back listening to you after a decade. And yeah, to start us off, I wanted to ask, right? You have been an alum of IIM, you went to NYU, you have taught at premier institutes such as ISB. Why did you make Arizona your home?
It's interesting. There is a personal reason why I landed at Arizona, and these personal reasons one relate to weather. After I came to the US, I spent my time in New York and then in Chicago because before coming to Arizona, I was at Northwestern for almost 10 years. And so, after spending 15 years in the north of the country, I was looking for a way where I could go back to having a weather which is similar to a place where I grew up in India, which is Hyderabad. And through a combination of luck and circumstance, I landed up in Tucson, which I really didn't know anything about. I didn't even know, if you asked me where on map Tucson is, I wouldn't have known. And the second reason was that my wife is also my colleague. And in academia, the process of tenure is a very important threshold in your career and progress. And usually, tenure is a very tough process. And for one person to get tenure is tough. For two people in a couple to get tenure in the same place would have been extremely hard. And so when I moved to Arizona, we actually moved with a deal by which, both of us with some gaps, we got actually tenured. And that was a combination of both the for professional circumstances and that strong personal reason. We ended up in Arizona.
Oh, thank you for sharing. Right? So, if you were to meet a 8-year-old today, how would you
Yeah.
explain these five things: credit, debit, balance sheet, income statement, and cash flow?
Yeah. Um, it's actually a good question. So let me see. I think of the balance sheet as the most important thing. If I can explain the balance sheet, I think I can sort of put the other pieces of the puzzle. And even if that 80-year-old doesn't get the other pieces of the puzzle, that's pretty okay, actually. So the way I think about the balance sheet is it's your economic story. And the economic story is what you own and what you owe. And therefore, that economic story, we think about assets as things which will bring us something in the future, right? And therefore, we have to, put down money today. But how do you put down the money? Well, either you can put in your own money, your savings, which will be the shareholders' equity, or you borrow from others and promise to return back, and that is what we call as liabilities. So I think if any individual can understand what I own and what I owe, then what the income statement really becomes is nothing but a snapshot of the two changes of the balance sheet. At one point, I own and owe something. At some other point, I own and owe something. Why did that happen? Right? And that change is really the income statement. And I think the cash flow, interestingly, is a very intuitive thing. It's probably a little more sophisticated concept, and I would not really attempt to explain that to the 80-year-old, except but to say that think of it as all the money that you've got in cash and what you paid out in cash. And I think that's what I actually even tell my students, even though they're not 80-year-olds. But I think
But
this
they
is what
act
it
like
is.
that.
Well, I'll reserve my judgment on that.
I'm just teasing. Yeah. So, why do you think accounting is not taught early on? Like, why does somebody have to wait to be school and that becomes a matter of choice?
Yeah.
Whereas, that could be a life skill in most circumstances. So, why do you think that
Yeah.
happened in academia?
So let me sort of a little bit more generalize your question because I think it's more than accounting because accounting is sort of like record keeping, right? But what is more important is I think maybe if I can take the liberty of reframing your question,
Absolutely.
why is personal finance not taught at a earlier age? And I think that's very important, because if you think about how our lives are guided, right, I think there are a few important cornerstones in every individual's life. The most important one, of course, is your friends and your family, right? The second is your health and your well-being. The third is, I think, your professional satisfaction. And the fourth in that cornerstone, I would say, is managing your personal finances. Because why I call them cornerstones is that just having one of these is somehow not sufficient. You need to have a combination of all. And strangely, I don't think, while we very much, our thoughts are dominated by personal finance at many points in time, we don't formally teach it. We kind of sort of almost expect to learn it by experience. But that is true. I mean, a lot of other things also, like even health and all that, we just learn through personal experience. But accounting actually really comes into play when you start talking personal finance, right? So I know that in the lead up to this conversation, you had also mentioned about investing and all that. And when you ask yourself, how do I become a better manager of personal finances? Investing is obviously a very important part of it, not the only part, but important part. And when you start asking yourself all these things, the record keeping, which is really accounting, plays a very key role. So your thought is actually excellent, and there is a move to push it down more and more at high school levels. Like both my kids now, my daughter has just graduated from high school, and my son is in high school. And so they study economics, but they spend too much time in the abstractions of
Marginal cost.
economics. Exactly. Yeah. And they talk about price theory, they talk about equilibrium and all those things, which are important. But I wish there was a little more talk about personal finance, and then accounting would definitely start showing up when you talk about that.
Thank you. At one point, getting to investing, right? Can good accountants or those who have a strong grasp of this particular subject be good investors? Conversely, do all good investors need to be conversant in the subject of accounting?
Hmm. Good point. I think investing is a huge amount of luck and circumstance combined with knowledge. And I think I would love to actually come back to the theme, because one of the things which surprises me always is the amount of bragging and the amount of, in general, brave words which are spouted by so-called investors. But I think there's a lot of luck and circumstance along with knowledge. So I like your other statement, right? Without knowing or understanding financial statements, can you be a good investor? I don't think so, because what will happen is then you are just throwing a lot of Hail Marys, right? You are not understanding what are the fundamentals of the firm, or fundamentals of the basket of things that you're investing in. And so I would actually very much agree with you that if you don't know accounting and well, and I would even say financial statement analysis and well, I think you're more a good investor by accident, not by design. Yeah. Uh,
Thank you. Was there more to it? I don't want to move to the next one before
No,
you
I think
finish it.
I'm just still ruminating. I think your sort of formulation of it was very good, and so maybe let's come back to this whole notion of what makes a good investor, and I think the issues of luck, timing, and all are extremely important, and I think that's the difference between knowledge and investing, I think.
Which, if you allow me, that is, at one point in the past decade, you had shared privately in a
Yeah.
conversation that you had beaten the index 3 years in a row, or for 3 years. Now, remember, this happened a decade back, so I may be misrecollecting that.
Yeah.
Do you feel comfortable sharing your current track record? Are you still actively, that is, if you're still actively in
Yeah.
stock picking, not indexing, or or
Yeah.
something
Yeah.
like that. But
Yeah.
again, I don't
Good
want to push
question.
you.
Yeah. No, no, I'm happy to share actually. I mean, I don't fully have all the numbers right now at the top of my
Absolutely.
mind, but actually, one thing I must, though, in all humility, say that, like any person who's prone to bragging, you're bound to be the mean reversion, which you mentioned about. So yes, I did beat the index at the time that we had this conversation. And then, of course, I've eaten the humble pie many times after that till this point. And that's very important to understand and very important that, I always, I hope all your listeners also realize that. Never think that, you're going to be beating the index so consistently. It's just not going to happen for many reasons, right? But to set the stage for that, what I have done is I've actually realized that good investing is also taking judicious risks. Like I said, there is no, there is a lot of luck and circumstance to it. And so what I've done is after our last conversation, because I remember we must have spoken about 2015, around 2017 or so, I actually took a more uh, if I can say more pompously, a more thoughtful approach to my portfolios. And clearly, a bulk of my long run funds, especially retirement oriented funds, are all indexed because, and we can talk about why indexing. But I've also started significantly allocating a lot of discretionary funds to the stock picking portfolio and to a even more risky and more let's say volatile
Aggressive.
portfolio of options. And I think I would say that for most investors who are getting a little more sophisticated and are a little more willing to lose some wealth. And that's a very important caveat here. Investing is not, we all have this popular notion that investment and investing skills are all force multipliers, but also they can be destructive to your wealth. So you have to sort of allocate some risk capital, which I think you should. Of course, it's always have some regrets about losing, but you should be prepared that it doesn't damage your financial position, right? And that I think will. So, as a combination of all of these, I think if I aggregate returns across these portfolios, I think I've comfortably beaten the indexes, I think, many years, right? But I think it's a bad benchmark. And that's my other big learning since our conversation is that the risk and return are very closely linked. Okay, so when we talk about beating indexes, let's say take S&P 500, right? And someone says, and this is very popular, right? You keep on hearing about so and so manager has beaten the index or whatever. The way we unfortunately never talk about in the public domain so openly is what is the risk that you took? Because if you go back and remember the basic portfolio theory, right, it's also about the Sharpe ratio. It's not simply about the return, right? So for a unit of risk, right, if I get a higher return, then I need to be able to do a like for like comparison. When we diversify on S&P 500, what we have really done is we have a very wide diversification across very large companies and across many industries, right? And therefore, what we have done is our returns, whatever they are over the market. Now, if I pick some fly-by-night stock, I don't want to name a particular stock, but
Meme stocks.
well, let's call it just simply a meme stock, right? And I deliver, let's say, if I just got lucky and I have a 40% return or something like that over the 6 months or 1 year, does it make me a game-changing investor? And am I the next Warren Buffett? I think not, right? Because you never told me about the underlying risk in that. And that, I think, is the sort of thing which always bothers me in these when I listen to maybe something like CNBC, or when you look at any other marketing material that fund managers put out, right? I would really like the discussion to be not just about return, but about also the risk parameter, and so that investors can judge what is the, if I normalize for the risk, did you beat the index?
Um, Speaking of Buffett, did you ever make it to Omaha for the annual shareholder
No,
meetings?
unfortunately, never.
Hopefully, I see you next year. I was there for the first time. Always wanted to be there. It took me 10
Excellent.
years. This year, I
Yeah,
made it. Uh, I,
fantastic.
I, I hope to see you there next May if you so choose to.
Yeah,
I invite
yes.
everyone as if it's my
Okay.
meeting, but
Well, you're Buffett's right hand man, so why not?
no, 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 no. Yeah. So if you want to, if you feel comfortable sharing, when did you venture from the regular vanilla indexing, if we may call it vanilla,
Yeah,
to individual stock picking? Uh, how was your journey towards it? Again, you don't have to name
yeah,
names. Please do
sure,
not share what you're not comfortable with, but
sure.
whatever you feel.
Okay, so let me sort of uh, talk something which is, I think, philosophically very important for everybody to realize. And I came to this realization a little more recently. And what the realization I came to is that we live in times, and perhaps it's true even going backwards, is that the public stock markets seem to definitely have some watershed moment every 10 years or so. You can say it's a every decade phenomena, right? And in my investing lifetime, which I would say really seriously, I was starting to think about these issues when I joined in my PhD program at NYU. And so the first watershed moment I experienced was about 2001, 2002, which was the collapse of the internet stocks, right? Because we had a big run up from 95 onwards. And the second big watershed moment was 2008, the financial crisis. And then came along COVID about 2020, right? And why I say this is that I think with my hair becoming a little whiter and my becoming and looking a little more hopefully wiser, is that this is going to repeat. And
I do
so
see
what
I do see the wisdom, but I can't see the white hair.
camouflaged very well. But what is
Maybe it's my
important there?
eyes.
Yeah, it can be. But what is important enough is that as a result, I think we have to realize that risk is going to be very key. You could actually, and so why I came to the realization in 2008 was when I looked at it a little more soberly at about the time that I was about to move to Arizona in 2010. I evaluated how I had done because mostly I had shunned investing in individual stocks because from an academic who studies seriously, I think it is very hard to justify individual stocks. So like a true academic, I was only investing in indexes. But what I realized to my shock was from 2002, when I actually seriously started putting money away because I had a job as an assistant professor at Kellogg Northwestern, and I had surplus, savings and everything. And I looked at post 2008, I realized that all my returns had been wiped out. So, in real terms, actually, I lost money because with the depreciation of the dollar, right? So, all the money which I had been diligently putting away from 2002, where my real savings, right, to 2008 and 9, and combined with it was in 2010 when I was moving to Arizona. Um, I had a very beautiful house in a suburb of Chicago. It's called Winnetka. And we sold that house. And I actually lost money in that sale of the house because, and that's kind of hard to imagine because if you look at those North Shore suburbs in Chicago, they are such beautiful places, very attractive for families. If somebody had told me that you'd actually get less than your purchase price from 2003, I would have said, get out of here. And actually, it happened. So this kind of made me seriously think about how I need to assume more risk in my portfolios. And which is a kind of a weird thing, right? You would have actually said, Sham, now when you say this, what you hopefully are trying to tell me is de-risk your portfolios. But what I realized was that I had to come up with some way of asking myself which parts of the portfolio will be less risk and therefore will be relatively lower returns, and which parts of the portfolio will be higher risk, right? But will, of course, deliver higher returns, but with the possibility that I kind of also, have a bigger shock. But I came to a conclusion, therefore, that I needed to start allocating some percentage. And that's really when I came in 2011, I think I would say, I started investing in individual stocks, not in a very big way, right? Because it was so much, in a way, I would say, heretical to my thinking as an academic that somehow this is a good thing. But I just went slightly the other way. And so that would be the time that I actually started looking at individual stocks.
Thank you for sharing. I know you shied away from naming names earlier, but I was going to ask
Yeah,
historically, what
yeah.
were some of your best wins, if you feel comfortable? That is.
Some of them are not very hard to guess. For example, Tesla, right, is one thing. But I actually would like to talk about something which is very interesting, actually, which I currently own, which is Boeing. Now, I in those individual stocks, I actually tend to be what I would say, and I have some parameters actually, but I tend to actually be a buyer in adversity. So to me, it's very important that if there's an individual stock I buy, uh, and Tesla doesn't fit that, but Tesla was more very, very speculative play. And I think while Tesla was a big win, I think the amount that potentially I left on the table, right, by exiting Tesla pretty early on, itself is so large that I would not even call Tesla a win, right? But that's life. I mean, that's how investing will be, right? But Boeing is quite interesting, and it kind of represents my attitude and thinking. I like to look at individual stocks which are dominant players in the industry that they are in, and that industry is something which is structurally vital for the economy, right? And since you are a follower of Buffett, I would say that in a sense, this is sort of not very different from Buffett's philosophy. It's just that, the scale that he employs and the amount of control he has. Buffett is almost like a private equity investor in those
Correct.
companies. But to me, Boeing, therefore, represents a fairly important illustration of my thinking is that barring some kind of a very futuristic technology, we are very dependent on travel and travel in planes. That's not going away, right? When you look at the global industry, the players are basically Boeing, Airbus, and then some very small players, right? Um, Even Airbus, interestingly, is largely funded by these governments. So, in the space where you can say private sector enterprise, Boeing is very dominant, right? The other thing with Boeing is that it's got a very interesting portfolio of businesses. Is that while aircraft manufacturing is very big for them, they have a equally large defense business, right? On which the contracts are typically very locked in, and they tend to be cost plus contracts, right? And then they have the third sector, which is very promising, which is the space business, right? And they have been very early in that space business. Of course, other players have come and dominated the areas. So I think I like the fact that a stock like this is singularly in industries which are not going to vanish and their dominant position is not going to go away. So what's the risk with these stocks? The risk with these stocks is terrible management, right? Typically, what happens is that if you have those parameters, right, why the stock could be doing well is purely because governance is horrendous, right? And they would have probably lost their way, which is exactly what happened to Boeing. And so I like to think about companies. If I'm buying individual companies, I buy individual companies also with a lot of patience. This is something which I learned as part of it. Because early on, when I used to buy and I used to have some return run up, I would actually immediately sell. Think Tesla, for example, right? Because I generally did not have so much confidence in my own pick. And I would say, well, if I've got some decent return, it's time to go because, that I can move on to that, free up the capital for the next thing. But over the past 5 years, I've learned to be a lot more of a patient investor if it's individual stocks. And so if my criteria are met, I actually wait for that whatever is bothering that company, or whether what's bothering the markets with respect to the company to play out. Because I think once that gets played out, if the fundamentals are really good, that is, they're dominant players in that particular industry, I know that it is going to be a good investment. And so I use, again, very strategically the times when the market really falls out of love with those to keep on putting more and more capital. So the big issue is the dollar cost averaging. I very strongly believe in that, is that when you want to buy something, never buy at one shot. Keep on thinking about dollar cost averaging, and so that's sort of a more rambling answer to your question. So uh, I could say that more think about companies which sort of meet those criteria. But I also want to caution, sometimes you go wrong. And I've gone wrong also. And I will say one specific name here. In fact, two specific names, both of them you will see that share our common characteristics. One is Alibaba, and the second is Tencent. I think these companies they meet a lot of my criteria. They are very dominant players in what they are, what they do. They have got a huge market opportunity in China, right? And they have been very astute in expanding that market opportunity globally, right? Management actually is pretty good. These guys are very smart. But what I did not factor in was the political risk. And this is where you start learning things, right? You always kind of learn in investing. I think I had to actually exit my positions in both Alibaba. I still hold Tencent actually, for various reasons, because I think but Alibaba, when the Ant IPO was nixed, I actually realized that they had crossed a line, which is an invisible line, and this company will not succeed, despite being a very, very impressive company. I mean, if you look at some of the technology that they have and some of the people that they have, it's fabulous. And so you kind of learn. And so that's the other part. So everything, just because it meets my criteria, it may not necessarily be a good investment.
This is where this is the first time in the conversation where I respectfully disagree. I still agree
Okay,
that
please. Yeah,
so 50% of my net worth is in the two names you mentioned, both of
excellent.
which are positions that I continue to hold. So 25% each. And
Yeah.
I still believe that your early analysis holds true because regardless of the political risk,
Mm,
I do not think anybody is going to kill these golden gooses, or gooses that lay golden eggs.
Yeah.
On the aspect of and financials, right? The Look, what happened there was wrong, and any good government should step in and be enforce punitive measures, which is what happened, and that's
Yeah.
what you expect good governance to do. Now, again,
Yeah.
I'm talking very specific with regards to the action on and financials, and
Yeah.
the last batch of fines was just enforced on. I don't know if you've seen the story play out.
Yes.
uh,
Yeah.
uh, they they just impose the last set of fees. What people, if we want to get into businesses, we can, but most people think of Alibaba as just an e-commerce company. It's an advertisement company, a shipping company, a, a, a international e-commerce company, a cloud company, a tech company, and now soon it will venture into AI. I think it has a, going back to your early point, selling too early. I think it has a several decades worth of runway, and so
Yeah.
does Tencent,
Yeah.
which we seem to agree on.
Yeah.
But
Yeah.
I wanted to feel free to poke holes again.
Yeah. Yeah.
I acknowledge the political risk. I believe that the business success will be decoupled for it, but only time shall tell, perhaps.
No, I
Uh,
totally agree with your thinking. Let me also say that, it's not like I do not have regrets about exiting Alibaba, but my suspicion, and, it would be very interesting if 10 years later we had this conversation as
we
to where
will.
this would go. Yeah, the challenge about predicting policy of governments, which are fairly opaque, is that uh, there is a invisible limit on Alibaba, which is what in my reading of the situation is. So what I don't know is where is that invisible limit, right? And so it becomes very hard to judge. I mean, what the Ant Financial told me was there was a public manifestation of what the limit to Alibaba will be. Now, the other thing which did not, and so let me sort of also say that where I think I have a problem with the Alibaba uh, as a company is that the following. If I look at Boeing, right, and I don't think that the current management actually is a good management. I would say that, because some of the players are actually the same players who were on the board when the earlier CEO was not doing things very well, right? In case of Alibaba, so what I said was I look for management change over time, and I'm patient. But in case of Alibaba, I am not very sure unless the government induces a management change. This is a promoter company. This is a company where, there are a few people who own dominant stakes, right? And they may lose those stakes by diktat, by fiat, right? But they voluntarily are not going to exit, and they're not going to sort of change their management, right? And one of the things which troubled me about Alibaba was when the whole discussion leading up to Ant happened, right? What it also told me was you cannot function in an economy like that without having a very astute knowledge of what the government is thinking and what the government will do, right? And I think the management at Alibaba ran through a lot of red lights. And those red lights were becoming very clear. And when they went to so many red lights. And if you realize, lots of the other companies, ranging from Baidu to Tencent to lots of the other big names, their CEOs really read the room and they immediately changed their public behaviors. No, we don't know what their private behaviors are, but they changed their public behaviors, except for the senior
Totally
management.
agree.
That is where it a little bit bothered me. But
Tot-
not to make a too fine a point on that. Yes.
Totally agree with you. The commander in chief who misbehaved from the eyes of certain people is out of the picture and teach has taken up academics in a different country, I hear.
I wish I wish I was an academic like that.
But
But you're
anyways,
right. I agree with you. Hopefully, yeah,
uh,
yeah,
but I'll take you up on the offer. Maybe we reconnect in a decade, and you can tell me how silly I was to believe what I believe.
yeah, yeah,
But the on that front, right? Do you when you like something, what do you think about position sizing? Because people talk about entry points and exit points, but to the earlier discussion on risk, position sizing can wipe you out of the game.
yeah,
And
yeah,
as shared
yeah,
by me, I may be making some
yeah,
stupid moves here, but
yeah.
yeah, how do you cap the
Yeah.
position size? Or
I think there are three elements which are always important, right? One, and this is independent of, let's say you identified a particular investment opportunity, a particular firm, and you say, okay, this is what I'm going to do. But how much and when you will exit, how much, when you will enter, when you exit, are three very important decisions, right? So they're interconnected in a way, right? So let me take a few minutes to therefore answer your question, but not so directly as you posed it, right? The first thing is you have to realize that the point of entry is very important, because by misjudging the point of entry, you kind of are going to misjudge your point of exit and also the your position size. Okay, so let me put it simply, right? Suppose I bought a overvalued position, right? Then clearly what's going to happen is that my potential exit, right, is not going to be problematic at whatever point, because if I'm looking for a fixed return, then I'm going to be greedy. I would like to see a bigger run up, right? Now, my position, what will happen is that, remember, I like to do dollar cost averaging, right? And then I have to therefore start thinking about putting in more and more in order to either dollar cost average down or maybe accept a lower return. So, what I would say is that I always look for, therefore, the entry point is very important. You should be convinced about the underlying business, and it would be really nice when the market really has beaten up that stock, right? So every day, for example, around the earnings season, especially, I always scan to see those double-digit declines, and I always find them very interesting. I always look for my entry positions, given that I already have thought about some firms and I'm sort of watching them. When those double-digit declines happen, I look at the earnings release, I read the earnings announcement, and if I have time, I actually look at the analyst conference call transcript, because I like to get a sense for what is going on and what is it. And one of the things which I really love and I really jump on is when I realize that a lot of the disappointment is short term in nature, right? If you know that, or you didn't meet these expectations, or, somebody said something, or the management was being stupid, or whatever, right? And so at that point in time, now you have a decision to make about your position size, as you say, right? But it's not the total position, but the entry position. So what I've started doing is I actually do two things. I don't, uh, either I may just outright buy the stock, or I'll buy call options. Because what will happen is that way I kind of at least lock my position, right? And it tells me that, okay, I can now think about it. And then starts my accumulation strategy, right? Many times what will happen is that if I've been, if I've looked at the company closely, the disenchantment may actually not be a one-time disenchantment. In fact, hopefully it is not a one-time. It will be a repeated disenchantment. And so then I use those opportunities because I generally am patient, right? So I can sort of keep ramping up. But what will be the position size? I don't think I would uh, be as brave as you by taking a 25% or a 50% in an individual stock, because to me, I want also the capital to play with. I think to me, uh, more than like, say, 10 stocks at any point in time, right, fully invested, becomes very hard to follow because I'm looking for certain characteristics in them. And because I don't have that mental bandwidth, and because I have a daytime job with all that, so I kind of say that, I'm going to limit myself. So a crude rule of thumb would be, therefore, against my intended investment funds, I would not invest more than 10%. Crude rule, right? But clearly it won't be so. It will go up or down. And this is why I think options helps me to sort of also manage that size, right? And so by buying call options, I'm actually not right away, putting in all the amount. So I kind of try to combine my individual stock portfolio and my options portfolio. I take decisions in them jointly at times. Sometimes they could be separate, but mostly with the entry positions at least, I do it together. The exits, of course, are an interesting question, right? I actually have hard targets. So, like, I would say that in an individual stock portfolio, I will set a particular return number. And in the options portfolio, I'll set a particular return number. And clearly, the option portfolio, the return number will be much larger than in my stock portfolio because it's a fully invested portfolio. And so typically what I try to do is, if those have been achieved, I actually exit. Even if I really think that this is great, right? And I just exit because I think my objective has been met in some sense, right? My objective again was my return, right? And so in some sense, and that's why for me the entry and the position size are actually very important things, because then they dictate when I'm going to exit.
We have been talking about these things, but do you have a checklist? You mentioned you earlier, you call them criteria.
Yeah,
Do
yeah,
you feel comfortable sharing what those are for buy? We spoke about the
yeah,
sell side a little bit
yeah,
now. So
yeah,
what makes a good investment to you? You can take an example like Boeing
yeah,
or Tencent, who you
yeah,
feel a little bit optimistic about, and what were the
yeah.
things that checked out for you to enter those companies?
I think I've sort of hinted at what they are. So I don't actually have that sort of discipline, unfortunately, of having a 10-point checklist which I go through. I'm always so here's what I do, right? Um, I use the CNBC app, which is free, and I'm a cheapskate at these
Absolutely.
things. So I actually look at that every day, and especially at market openings, and sometime in the evening after the markets close. And maybe, sometimes I don't have time during the day, but I may just glance at that. But for me, what's important is that in the checklist, I have, sorry, not checklist, but I have a very long watch portfolio. And the watch portfolio is dominated by these companies, which I kind of have a general sense that they are strong companies in terms of their business, right? It's a business which is a fundamental business. So when I say it's a fundamental business, at one extreme you can think of as utilities, but utilities are not necessarily something which I want to buy in my individual stock or option portfolio, because in a way, when I buy the index, I'm buying like a utility, right, in terms of the return. So I don't follow those utilities, but I look at companies which are good in like if it's a technology company, if it's a pharmaceutical company, right? I like to see companies which have something unique, right? So, for example, right now, Moderna is one company that I'm invested in. Right, it has its ups, its downs. Every time there's some new news about how government wants to, remove subsidies on COVID vaccines or whatever, it will go down. And I always use those as buying opportunities because, and I could be proven wrong. So since you wanted an example, see, for me, Moderna is an interesting company, not so much of that one particular vaccine they make, but I think they now have a platform with the mRNA because there was a lot of skepticism surrounding mRNA, right? But now we know that
It
at least
works.
in some it works, right? So to me, what it means is that they have the potential to come up with more interesting blockbuster drugs, right? So that would be a kind of company which I would say keep buying whenever the market fall out of line, love with it. So every time there was like I think a month or two ago when there was some COVID vaccine announcement, Moderna took a big hit. I think they went down 10 to 15%. I took that as an opportunity to accumulate some more, right? And so therefore the company should have fundamentally something which we need, right? So like Boeing planes, right? In case of Moderna, those medicines, right? Um, and it should be very dominant. It should be unique in that respect, right? Not a utility, but pretty unique in an open market situation, right? I'll give you a example of a company which I don't like, even though I could be completely foolish and I'm completely probably wrong. It is Meta, for I find that, in my personal view, I find Meta to be not clear at all as to do I need the product? I don't really think so, right? I mean, there are many social media companies,
What
right?
do your
And
kids think about it, though?
oh, my kids probably think completely differently. In fact, that's a second reason why I don't like Meta is I actually. I think I am a very, very strong advocate for mental health and for well-being. And I think what we are witnessing in our current future generation is immense destruction of thoughtlessness on part of these social media companies. In fact, yesterday I was listening to a wonderful podcast by Vivek Murthy. He's the Surgeon General, and he said something which kind of stuck with me. And I said, wow, this is a great insight. And I would recommend that, follow this guy. I think he's a very thoughtful, very, it's a deep thinker. And so what he says is that companies, when they give away a product for free and say, use it, right? It starts assuming the role of a public utility. It's a public good, right? When you supply a public good, it is just but imperative that we ask ourselves, is this public good risky to us, or is it got some benefits, right? And so, for example, if I could be, let's make up something like a tobacco company, and I keep handing out free cigarettes, right? It's imperative that we understand that is this a good thing or a bad thing if it's a public good, right? And he was raising this issue as to none of these companies, social media companies, are willing to part with data to researchers very clearly about what is the consequences of the consumption of this public good, right? And he says that is not reconcilable to this notion of this being a public good. So for various reasons, that's why even though it might be a good investment opportunity in terms of returns, right? I am not particularly enamored by companies like this whose product, I don't know whether it's clear. It might be dominant, but what exactly is that nature of the product? And whether it will have an enduring appeal, and what exactly causes this? And I don't even understand what their competitive barriers are, right? So
You
I would
mentioned
say,
you
yeah,
mentioned you mentioned tobacco companies earlier. And
yeah.
think of this as a dopamine dealer, tobacco dealer. Replace tobacco with dopamine, and all your questions are answered. Now the
Yeah,
choice is up to you if you want
yeah,
to.
yeah. No, it's a good way of framing it, actually. Yeah, and I think that's exactly what I think, in a way, Vivek Murthy's point is. is that, we got to. So I don't find those sort of businesses of industries that attractive because I don't see that as a dominant, useful product for the economy. But again, these are personal held opinions, right? Because ultimately, fortunately, I'm not managing public money. I'm only managing my own money. And so, I have the luxury of, managing my money as per what my personal beliefs will be. And somebody else could completely disagree and could say that, that's not the way you do it. And this is an important debate which is going on. In fact, I am right now, as a off topic, thinking about putting together a course on sustainability, right? And one of the things which I'm grappling with in that is that the notion of what is investor maximization and what form does it take? And is the objective of the firm simply investor or stakeholder maximization? And what does that mean? I don't have answers to any of these questions, but I do think that these questions do come to a head very quickly when you start thinking about investing and start thinking about, how you make money. And but that's a sort of a sidebar.
No, definitely. On those lines, though, I have a question. When you think about maximizing investor or shareholder equity, or
Yeah, yeah,
shareholder value, my bad.
yeah.
What do you think of dividends versus buybacks within that context or backdrop?
I don't have a particular opinion on that actually, because I don't know whether I had that case written up by the time I taught you, and somehow in a basic accounting class, I think a lot of the nuance gets lost. But I actually have in most times when I teach classes, especially valuation or financial statement analysis classes, I talk about Apple. I have a whole
That
class
was the
devoted
case.
to Apple. That was a case. Okay, yeah.
Yeah.
And one of the questions, if the discussion goes in those directions, I always raise the question is Steve Jobs had this opinion that I will never pay dividends. So he had something against dividends. And if you read Walter Isaacson's book about Steve Jobs, it's kind of interesting, right? He was a man of firm opinions, right? And I joke in the class, Steve Jobs would say, consumers don't know what they want, I will give it to them. And similarly, his opinion was investors don't know what they want, I'll give it to them. And dividends was not what he thought, right?
Dividends are
And
tax inefficient, right? So there's a case against them there that, hey,
yeah,
you
but
much
they
rather do a.
also, yeah. So I think the question is, do I really want that firm to be thinking about the marginal tax rate of individual investors, right, which may be widely different, and their financial situation, which may also be very widely different, right? There could be some people, right, who may actually be buying those stocks for that dividend in order to fund their retirements or something, right? And so there could be many different reasons why people buy. And so I actually have no formed opinions on what should be done. And why I raise Apple is that we know clearly that once Steve Jobs died, and when Carl Icahn was pressing on Tim Cook, they actually started paying dividends. And to me, when I look at Apple before versus after, if I just condition it on the dividend payment, it seems to have made no difference to Apple, either in terms of operations or in terms of the returns. I mean, it caused a lot of strange issues in the balance sheet because always students ask, how is this company in 2015 had about $204 billion in non-operating assets, but had about $60 billion of debt, right? And then you get into this very long explanation about the tax and various issues, right? But my point is that I don't know whether I have articulated for myself in my mind any particular position on one versus the other.
A quick side note: karma has a funny way of playing itself. Now everyone's after Carl Icahn. I,
Yes. Yeah, yeah.
um, Well, we're coming towards the end of our questions here. You
Sure.
mentioned Boeing earlier.
Yeah.
There are a couple of airport stocks. So, much like how airplanes are a monopoly, have you seen? Uh, there are very few airports that are up for sale. Uh,
Yeah.
a company is in Mexico, another one in Turkey. Have you looked at
Yeah.
those at all, or
No,
no?
I don't. But I'll tell you something which interestingly happened. I was at ISB in July. We are in August now, right? July. And one of the things which came up in many classes and now for many other students was the issue of Adani ports and the Hindenburg report, right? And one question was, oh, do you think this is right or wrong? And I, of course, don't like to say whether it's right or wrong, but here is what it is, right? If I was an astute investor when the Hindenburg report came and Adani stock crashed, I would have actually bought Adani. And the reason is the following, right? It meets some of my criteria, right? Yeah, it is in a industry, just like you said about airports, right? I don't know if you've been to India recently. Indian infrastructure expansion has been impressive in the past decade, actually, right? Of course, our threshold was very low, right? And so this company is actually in that infrastructure very squarely, right? They have actually great returns, right? But clearly, the governance is not really what you want it to be, right? And so this is another Alibaba, right? So, clearly, I think Hindenburg probably made a lot of money in that in that short position. But I think for a long-term investor, that was a fantastic entry point. Um, so, yeah.
You, over the course of the conversation, have contradicted yourself by selling
Oh, I have.
Alibaba and
Yeah, yeah.
by
That's
by
life.
sticking. No, no, I'm just
But I've
teasing,
not
just
bought
teasing.
Adani ports, if you remember. So it's not that I have contradicted myself with my personal actions.
No, I'm just teasing you. I'm just teasing
Yeah,
you.
yeah, yeah,
No, no. Speaking of, India, China, or other regions, right? Oh, of course, you have some context of India. We spoke about China. Do you go through the whole PIS, having a brokerage account, and deploy some capital internationally, whichever troubled market it is? So here's the context of the question, right? In our
yeah,
conversation, you said you look for troubled companies, but you can also go for troubled geographies. China,
yeah.
India, time to time. Turkey is one that comes to mind. Do
Yeah.
you do you go very business specific for troubled times, or can you look at macro specific and go after a region? Have you done that with
I
India
have done
or?
an experiment, and I can tell you that that experiment has not been a happy experiment. So the way I did it was, the case for buying China and Chinese stocks is very compelling. In every way you think of it, if your portfolio does not have China in it, I think you're not future-proof for your portfolio, is my conviction. But standing today in 2023, I think I am sitting atop a large loss in my index of Chinese stocks, right?
Queb, Sweb.
So yeah, it is only with mixed emotions. So I don't know. So that's a challenge. And same thing when you say Turkey. Um, I don't have much confidence about a rational policy making, right? Because the whole saga about interest rates, how they have, when they should be raising them, they were cutting, and So to me, I think that headache, like I said, I have only fixed bandwidth, right? Because of headache, I have stepped away from that. I have a fairly large position in emerging market index, which I can tell you in the past 10 years has done horribly. And in the first 10 years that I held it, it did fantastically, right? So, so I don't know what is the horizon over which one should think. I think these are very long horizons. And I have not yet come to that horizon yet in my own investing career. So,
Thank you for sharing. Right, so I'll have
Yeah.
to call out a question from Adam Tank, my batchmates,
Yeah.
pertains to our class. Right,
Yes.
are banana stands still a good investment?
Was it the banana stand at that time? Okay. So it's become a juice company, by the way, now. so,
So how would
so
we how would we allocate capital between the banana stand we had and the juice company that exists now?
if you strictly were to attend my class today, you will hear about bananas only in context of Wildcat Juice Company. And so I don't know what to make of that, but nowadays it's all about kumquats.
Uh, Thank you so much for taking the time, Professor. It was an absolute pleasure, and hopefully, you take you you accept the offer a decade from now, and we can look back at some of the positions we discussed.
Sure, absolutely.
Thank,
Lovely talking to you, Ninad.
thank you.